Hey there YouTube. So in this video I wanted to cover the IRS Form 8594, the Asset Acquisition Statement. This form is filed during the tax year by both the buyer and the seller of a business. So if a buyer acquires assets using a trade or business from a seller, both parties have to file this form with their tax return to report the acquisition. So we want to go over highlights of the form and then an actual example. So I've got two slides and then an example of an 8594. Okay, so who needs to file? Like I just noted, it's filed by both the seller and the buyer of a group of assets. And these are assets that comprised a trade or business. So in the example we're going to look at, if you buy, let's say, a corner store from a seller, the corner store has multiple assets within it, right? It's going to have the building itself. It's going to have some inventory, right? Some stock. And then it's going to have, some equipment, furniture, fixtures, other things like that. And so if you want to buy the corner store, you want to buy the whole thing, right? And so you're buying a group of assets that comprise a trade or business. Okay, so what information is required? Well, the first one is you need the identifying information of both the seller and the buyer. So on the form that you file with your tax return, you do have to include your information, obviously, because it's going with the tax return, but you also have to include information on the other party to the transaction. So if the seller is filing his tax return, his 8594, he needs to include information on the buyer. And so the IRS uses this to match up within their systems, right? So each party needs to file the form. The other information that's required are the assets that were actually purchased, the FMV of those assets, and how the sale price is being allocated across those assets that were acquired. So let's look at a simple example here. We have John Q, taxpayer, is buying a corner store from seller for $850,000. Okay, now during the negotiations, obviously the buyer wants to know how'd you come up with that amount, right? So the seller provided the following schedule, and this was included with the purchase and sale agreement as an appendix, right? So the 850, the seller said, well, this is how I'm coming up with that. The operating account for the company's got $25,000 in there. I'll leave that in there, so you as the buyer are taking over that account, and you're taking the $25K with it. The amount of inventory stock that we have on hand at the time of the purchase is going to be $125,000. That's what's in the store and in the back, right? The fair value of the building, he's assessed at $400,000. The amount of equipment in the store are $50K, and then he assigned $250,000 of goodwill towards the purchase price. Okay, so let's look at the actual form itself and see how these numbers get transferred over there. So this is the 8594, right? This one is being filed by John Q, so he's the buyer, right? So we check purchaser as the purchaser of the assets. John's social security number is up here, and then here's the information of the seller, right? So seller name, address, and then the seller's tax ID number. So obviously the seller, when they do their own 8594, the information will be switched, right? You'll have seller's information up here, and then John Q's taxpayer information will be down here. So field 2, we have the date of the sale. So what date was the closing of the transaction, and what was the total sale price, right? So here we have that $850,000. Now part 2 here is where you break out all the assets that were purchased by class. The classes are relatively straightforward. If you look at the form instructions, you'll see what's included in each. Class 1 is cash, right? So we've got the $25,000 there. We didn't have any class 2 or 3 assets. These are things like publicly traded securities. You might have some receivables in there. Those fall within those classes, but we didn't have any of that. So class 4 was the next item we had, which is inventory. That was the $125. And then class 5 are depreciable tangible assets, so things like buildings, furniture and equipment, fixtures. So that's where we get the $450. Remember, the building was $400,000, and then $50,000 was the amount assigned to the furniture and fixtures. And then class 6 and 7 are those intangible assets. So class 6 are section 197 intangibles, so things like customer lists, non-compete agreements, certain licensing that you might have acquired that has some value attached to it. And then Class 7 is the overarching goodwill. Right, so Class 7 goodwill, you'll see is kind of that plug figure. So when you're allocating the sale price. So when you allocate the sale price here, the instructions are pretty precise, right? So the first issue is allocation of sale price. It's always 1-for-1 with Class 1 assets. So when you have cash, you're just going to allocate whatever amount is the fair value. So if you look at the bank account, you've got $25,000 in it. That's what's being bought. That's $25,000 of the purchase price, right? That's a 1-for-1. And it makes sense, right? Cash is just valued at whatever it is worth. It's only on these other items here, classes 2 through 7, where you allocate the sale price either 1-for-1 or you could do less, right? So the rules say that you can't allocate a sale price item that exceeds the fair market value. So if the parties have agreed that, let's say inventory, for example, is worth $125,000, the sale price allocated to it must be at least that amount. Or sorry, it can't exceed that amount, right? So it could be less, right? So $125,000 is the fair market value. You can set it at $125,000 or it can be less, but it can't be more. It's only in the Class 7 assets when you have goodwill that you can allocate sale price in excess of what the agreed fair market value was. And that, again, kind of makes sense, right? Because when we think about goodwill, it's hard to, assign a real value to it. It's always kind of this plug value where you have a purchase price where you're acquiring actual assets that you can see in front of you, maybe more easily measured fair values, and then at the very end of the list you've got this goodwill plug figure, and so that's where this $250 comes in. So the fair value they agreed was about $75,000 for the goodwill and other IP items, but the amount of allocation of sale price to that goodwill class was the $250. So that's where you get the plug value. And then at the bottom here, the total foots to $850,000. Now, question 5, these are fairly straightforward yes or no answers. We're really just looking at the written agreement to see if this was included. And so in our example, it was, right? John Q. and the seller laid out these different types of classes of assets and the fair values and the allocation of the sale price. And it was in writing and they agreed to it. Okay, so answer yes to both questions. And then in part 3 here, this is a supplemental statement. This is only used if you're amending an 8594. So in this example, we're leaving it blank because this is the first year we're filing it. But let's say if in year 2, after this is filed, they discover that they needed to amend some of these values up here, there were other changes, they would refile this 8594 and include this Part 3 statement. Okay, so one thing I really want to touch on a little more in depth is this question 5 here with these 2 questions. So if we jump back to the slides here, this is really important, right? So like I said, so the parties should include a schedule of these assets that are being bought, agree to the fair values of each asset class, and then agree to how the purchase price is going to be allocated. Okay, now if you agree to these in writing and it's memorialized and made part of that purchase and sale agreement, it's binding on both parties, right? So you have to file, each party has to file their 8594 exactly the same, consistent with what the allocations were. If there's no schedule included in the purchase and sale agreement, which unfortunately is quite common just because they miss it, then it means that each party kind of has to come up with their own values for what they think are appropriate, right? Now, the one problem with that is if each party is coming up with their own amounts and allocations and there's no consistency, the IRS could flag the inconsistency and then audit the returns, right? And the reason they're auditing the returns is because they're going to assume that if you couldn't agree, it means that at least one of you is wrong as far as how to allocate the purchase price across the different assets. And that's important because if we look at these different classes, each asset within these classes is subject to different types of depreciation and recovery rates. So for example, in class 5 assets where we have the furniture and fixtures, the buyer, once they buy those, oftentimes they can use bonus depreciation and depreciate 100% of them. So a buyer very often will try to inflate this class 5 asset class, particularly if there's furniture or fixtures in there, because they want increased depreciation expense at very early on, right? Whereas, let's say the seller might want to inflate like the class 7 amount for goodwill, because goodwill, when the seller sells them, it's just long-term capital gains. Excuse me. So they don't have to worry about things like ordinary income on inventory sales or depreciation recapture. So that's why there's often some disparity between these allocations if you can't agree on it. So the takeaway here is really it is important for both the buyer and the seller to agree to these allocations in writing. It's okay to have some back and forth, right? That's very common. But it's really important that you both agree and you file consistent statements, because you just don't want the IRS digging in on this and then perhaps auditing one or even both of you because you use different amounts. So that covers it all. I hope that was helpful for you. If you have any questions, please leave me a comment below. Happy to answer those. And of course, always appreciate a like on the video. Subscribe to the channel if you aren't already. And I hope to see you again soon. Okay, thank you.